Hello. India is passing through a major health crisis. The second wave of the pandemic has turned out to be far worse than most people anticipated. Rising COVID cases, deaths, non availability of hospital beds and oxygen, restrictions being imposed by many countries on people traveling from India, all this are very bad news. It would be rational to expect a strong market correction in this gloomy scenario. But the market is surprisingly strong and resilient. How do we explain this? First and foremost, it is important to appreciate the fact that this bull run in stock markets is global. Globally, markets are bullish. The most important factor fueling this bull run is the huge liquidity created by the leading central banks of the world. The cost of money, that is, the interest rates, are at historically low levels. A major part of the money created by the world's leading central banks have found its way into the stock markets. To give you an important figure, the total amount of money that came into the stock markets during the last 1 year is more than the money invested in the previous 11 years. In brief, this huge liquidity is the prime mover of the market. Also, fundamentals are supporting markets. Global economic recovery is strong, led by the US and China. Global economy is recovering fast, and this year, that is in 2011, global GDP is likely to grow by around 6%. This global economic recovery is aiding stock markets. The health crisis is serious, but the markets are forward looking. The second wave is likely to peak by mid May, perhaps. Already there are signs of the COVID curve flattening in many places. The trend which happened in countries hit by the second wave, like parts of US, UK, France, Germany, etc., is likely to be repeated in India too. The market is discounting this in advance. Before the second wave, the market had factored in 11% GDP growth and about 30% earnings growth for the financial year 22. We are likely to fall short of these estimates because of the localized lockdowns and large number of restrictions being imposed now. But the market corrections from the peaks in February have partly factored in this expected shortfall in growth and perhaps in corporate earnings too. The important question is, what should investors do now? This is a bull market. It makes sense to remain invested in bull markets. Even though there is pain in the economy, the organized sector is doing well. Q4 results are good. Results in the coming quarters will be better. Among sectors, IT, pharma, leading names in financials, particularly private sector banks and large home loan companies, metals, cement, and chemicals are doing very well, and they are likely to do well going forward. So remain invested in these segments. Also, it would be wise to book some profits and move some money into fixed income, even though fixed income returns are low. Thank you.